Who is really buying up the UK? It is not who you think. For years, the narrative around property in the UK has been dominated by familiar stories. Foreign investors buying luxury apartments in London, wealthy individuals purchasing second homes and leaving them empty, young people struggling to get on the housing ladder while house prices soar. But beneath this surface story, there is a far bigger and far more powerful force at play. Private equity, global asset managers and banks are reshaping the housing market. These changes are affecting millions of people across the country. To better understand what is happening, we have to take a look at how home ownership has changed over the last few decades. In the early 1980s, more than 2/3 of households in the UK owned their homes. Owning a home was seen as a natural step in adult life. It was part of the promise that hard work and saving would eventually lead to security and stability. But today, home ownership is falling. According to the Office for National Statistics, the proportion of households that own their home has dropped. In 1981, it was 68%, but by 2023, it has fallen to around 61%. For young people, this decline is even sharper. In the mid-1990s, around 2/3 of people in their late 20s owned a home. Today, fewer than 1/3 do. The average age of first-time buyers has also been increasing steadily. In the early 1980s, the typical first-time buyer was around 25 years old. Today, that average age is over 32. This shift reflects rising house prices and the growing challenge of saving for a deposit. Another critical factor is affordability. House prices have grown far faster than incomes over the last few decades. In 1995, the average house price in the UK was approximately 3 times the average annual income. But by 2025, this ratio has risen to around 8 times the average annual income. In London, it is even higher at nearly 12 times income. And Kensington and Chelsea in London remain the least affordable, with a ratio of over 27 times of annual income. This means that for most first-time buyers, buying a home is a goal that is increasingly out of reach. This decline in affordability is part of the reason why home ownership is being pushed out to older ages. Young adults are spending more of their income on rent. They are delaying major life decisions such as starting a family, and they are entering the property market later in life than previous generations. High rents also make it difficult to save for a deposit. Even outside the capital, rental inflation has significantly outpaced wage growth. This further reduces the pool of potential home buyers and increases dependency on renting. To understand why investors are flooding into the UK housing market, we have to take a closer look at the numbers. House prices have skyrocketed over the past few decades. In 1985, the average UK home cost just over £25,000. By 2000, that number had tripled to almost £78,000. And today, the average house costs over £269,000, an increase of more than 245% over the last 25 years. In London, the rise has been even more dramatic. The average property price in 1995 was around £108,000, and today it exceeds £650,000. Within the different property types, in London, detached homes have seen the steepest climb. In 1995, the average price was £257,000, and today it has risen to over 2.3 million. That is a staggering 800% increase. And it is not just buying a home that has become expensive. Rents have surged as well. The average monthly rent in England is now over £1,300, while in London it is over £2,200. In cities like Manchester, rents have increased by over 65% in the last 10 years. For many households, rent is now the largest monthly expense. With demand outstripping supply, rents continue to rise year after year. From an investment perspective, housing is ideal. It is essential, in limited supply, and can generate steady, predictable income. For institutional investors, this combination of high demand, limited supply, and rising prices makes the UK housing an extremely attractive market. This is exactly why large financial players are stepping in. What used to be a market dominated by small, individual landlords is now being reshaped by private equity, global investment companies, and banks. These investors view housing not just as shelter, but as a financial asset class. Rental income provides steady cash flow, while property appreciation delivers long-term returns. And because housing is essential, demand rarely falls, making it a defensive investment even during economic downturns. This shift is transforming the rental market across the UK. Institutional landlords can buy entire blocks of flats, fund large-scale developments, and professionalize property management. The result is a housing landscape where global capital directly influences who can rent and who can buy. Private equity and banks have noticed this trend. They have been buying up housing developments, apartment blocks, and entire portfolios of rental properties. One of the most significant shifts in recent years has been the rise of build-to-rent. This asset class and strategy is well known in the US for many decades. But in the UK, it is a relatively new alternative investment strategy. These are developments specifically constructed not for sale to homeowners, but for long-term rental. Large investors finance the construction. They own the buildings and they control the rental income. Build-to-rent has exploded in recent years. In Manchester, nearly 25% of private rented sector stock is now build-to-rent. That makes Manchester one of the UK's strongest BTR markets. But despite this growth, the UK's build-to-rent footprint is still small compared to international peers. In the US, for example, multifamily rental has been established for decades. In Detroit, around 43% of renter households live in multifamily properties. And in Charleston, this figure is as high as 74%. This just shows how much room there is for expansion in the UK. The UK is only at the beginning of what could become a much larger institutional rental sector. Build-to-rent investments have increased significantly over the last couple of years. They went from around £2 billion in 2017 to over £5 billion in 2024. Tens of thousands of new units have been developed with backing from pension funds, sovereign wealth funds, and private equity. In London alone, there are more than 120,000 build-to-rent homes which are either completed or under construction. In 2021, Lloyds Bank announced a bold plan. It aimed to become one of the UK's largest private landlords. The target: 50,000 build-to-rent homes by 2030. By the end of 2023, Lloyds owned around 1,000 properties. A year later, the portfolio had grown to more than 5,000 units. Other major institutions are also scaling up. Legal & General has built a portfolio of 15 schemes in 11 cities totaling more than 5,000 apartments. M&G and Blackstone, both early movers, continue to deliver thousands of rental units. And a new strategy is emerging. Nuveen, which manages $1.3 trillion globally, entered the UK market in late 2023 with a new approach. They have launched a joint venture to create the first single-family build-to-rent platform. Their flagship project, a 373-home development in Cambridge. These moves highlight something important. The competition for dominance in UK housing is now a contest between financial giants. Each one is seeking to claim the crown as the country's largest and most influential landlord. So, who is really buying up Britain? Not just foreign billionaires, not just second homeowners. It is private equity, banks, and global asset managers. They are becoming the landlords of the future. Their decisions will shape housing for decades to come. On one hand, they could deliver more professionally managed rental housing. On the other, ownership is concentrating in the hands of global capital. Millions of renters may be left with little chance to buy. The question is clear. What kind of housing market will these institutions create, and who will it serve? Thanks for watching, and please like, subscribe, and watch another video. See you in the next one. Thank you. Bye.